The last lesson I'll talk to you about posting to ledgers, but there's some other processes that we need to take in consideration. For that to occur, what I want to do first of all is to show you the accounting process. So in the first instance, a transaction occurs. It's a financial event. We talked about that before. I'll talk a little bit more about the specifics later. Then what happens is that a source document is generated. So we must have a verifying document to document the fact that a transaction occurred. Usually two parties involved, so therefore there's an original copy and a duplicate, for example a check, an invoice and so forth. This is a new step that I'm going to talk to you more about, is that we record all these financial transactions into a journal in a chronological order. And then the next step is we post in total from the journal into the ledger accounts, and that's the step that you know about already, but there's an extra step to make it more easy and streamlined. And the third and the last step in this process is that when we get to the end of the month, we sum up the final balances of each ledger accounts, and that final balance goes in the trial balance, and that will form our basis to go to the final step, and that is to report on a profit, net worth and a cash flow. Okay, what I'll be doing is referring to the diagram on page 39. As you can see, it is a good summary of what I've just said, but it shows you all the steps in one page, going from when a financial transaction occurs all the way to where I'm up to here, showing you how the journal entry will occur. So now let's going to have a look at what source documents actually are. They provide an evidence of the transaction. And as I said to you before, the original goes to the customer, and the person that sells or is the person that procures the particular transaction has the copy. We have two cash source documents. For example, if we pay something in terms of a check, or if we receive monies, we issue a receipt. And then there's the credit transaction, from when no cash flows straight away, but we have a promise for it to be paid later, usually 30 days. For that purpose, we have a tax invoice. If there's a purchase return or sale return, we send an adjustment note. Now you note here two other types of documents. They're for big organisations, namely a purchase order and a delivery note. Don't worry about those now. So when we move along, we now are at a stage where, when we get lots of these financial transactions, we want to collate and summarise them into a general journal. Now here is the definition of what a journal is. It's where all source documents are collated, so that makes it easier to post to the ledger accounts, which you've already seen. It makes it a lot less messy and streamlined. Now, what I'm about to show you is to bring together what we've learned already, and that is the debit and credit rules, and by then analysing each transaction and putting them into a general journal ready to be posted into the ledger. So the first question we must ask, what ledger accounts have been affected? And I'll illustrate that using an example from the book a little bit later. The second question that we must ask, what type of account is involved here? For example, if we identified cash up above here, it's an asset account. If we identified owner's equity, well, it's an owner's equity account. Okay, if it's a sales account, it's a revenue account. So we need to know what type of account it is, which then determines, by knowing what nature of the account it is, in the fourth step, to see whether we're going to have a debit and credit. So just to slow down a bit, number 3, the nature of the account. For example, we know that an asset is a debit in nature, so if it increases, it goes on the debit side. If we're talking about a liability or revenue for that matter, it's credit in nature, and if that increases, it goes on the credit side. So these rules we must be able to apply to know what side, or what if the transaction is going to be debit or credit. Alright, so that answers the last question here, what side of the ledger account is affected. This is all explained in text as well. it's best explained using a numerical example, which I'll show you in a moment. For this purpose, I'm going to show you using an Excel spreadsheet. Okay, what you've got in front of you here is, I'm looking on page 43 of the text. The transaction that I'm going to analyse for you is on January the 1st, the owner Jay Green invested $200,000 into the business. So what we must do is work out what accounts are involved, what type of account, nature of the account, increase, decrease, whether it's debit, credit, and what the amount is, and then I'll show you how it then goes into the general journal, and that's the task that I want you to do, to be able to take it from transaction into the general journal. Okay, let's go. So in the first instance, the owner, Jay Green, has invested $200,000 into the business. So the accounts involved in this instance, we're going to have cash at bank. That's that one. The type of account is an asset. I'm just going to type that there. The nature of the account is debit in nature. It's actually increasing. Okay, so it's gone from 0 to 200,000. Applying our account rules from the previous lesson, if it's an increase for an asset account, it's going to be debit. So I'm going to type in debit, and the amount is 200,000. Right. So let's look at the other account, owner Jay Green. In this instance, it's going to be capital Jay Green. Oops. That's an owner's equity account. I'm just going to summarise that for now. Owner's equity account is credit in nature. We didn't have it before. Again, it's an increase. And if we apply our account rules, if we have a owner's equity which increases, it's going to be a credit in the final result. So in this instance, you can see that to finish off, we've got a debit and a credit, right? So this is the analysis that I want you to do in order to get to this stage here. So once you get to use the account rules and so forth, I want you to be able to skip that step and go straight here what I'm going to do now. Okay, so in January the 1st, so you type in here January the 1st, the particulars, in this case we've got cash at bank. I've identified up here that it was a debit for 200,000, so I'm going to slip that straight away into here. Okay. The other account was capital, and we've identified before that it was a credit amount, 200,000. Okay. So that's what a general journal entry looks like. I might just fix this up so it looks a bit better. Okay, so let's just check. For every account, there's at least one debit and one credit. Okay, all debit items must equal the credit items, and they do in this case. All right. Let me try with the second example. This is just going on in the textbook. We bought a motor vehicle from ABC Co. Okay, for $35,000, but we paid a deposit of $5,000, so it makes it fairly complicated. All right. So let's just think about it. We've got an asset of 35,000. Okay, motor vehicle. Let's put that in here first up. Motor vehicle. Okay. The type of account, well, it's an asset. I'm just going to type A for asset. Let's just identify the other accounts that are involved here. ABC Co. You can see here that if we're going to pay $5,000, we're going to owe ABC Co. The difference, which is going to be amount to 30,000. Right. Let's just identify the account. ABC Co. is a person or a business that we're going to owe money to, therefore by nature it's a liability. Okay. And lastly, this is really difficult transaction to start with. We paid some cash. Right. So the other account is the cash at bank account. Remembering from before, from up here, we identified cash at bank being an asset. Let's see how the account rules work here. Right. So I'm just going to now do the motor vehicle first up. Asset, it is by definition debit in nature. It increased. If we apply our rules, remember, an increase to an asset account is always going to be debit. this instance is going to be debit for $35,000. Let's look at the bank account. Okay, I'm going to skip that until and do that one first. Cash at bank, okay, it's an asset. It's also a debit account. But in this instance, we paid $5,000, which meant that our cash account went down, therefore decreased. Let's apply a rule. An asset decreased, it means it's going to be credit. Okay, what was it for? It was for 5,000. So now I'm left with the rest, and you can probably guess that we need an amount of $30,000. That's the amount that we owe to ABC. Right? But let's just use the account rules to follow that through. A liability is credit in nature. Before this transaction, we didn't have a debt. Okay, we didn't have a liability. That increased. Right? Account rule says if we have an increase to a liability account, it's credit in nature. Okay, and as I've already worked out, it's $30,000. So we've done our analysis. We've worked out what debits and credits are. Importantly, this part back here. Let's put that into our general journal entry. So on January the 2nd, the 3rd, I beg your pardon, we bought a motor vehicle. Okay, we worked out that's going to be debit 35,000, so I'm going to stick that in there. The other particulars is cash at bank. Remember before we worked out there was a credit for 5,000. And lastly, we've got the liability to ABC Co for $30,000. Let's do our check again. We must have at least one debit entry and one credit entry. Yes, we've got that. Importantly, in this instance, all the debits, $35,000, was equal all the credits there. Can you see that? 5,000 plus 30,000, 35,000. So tick, yes, we're right, we're ready to keep going. Hopefully you're getting the hang of this, but I'm going to continue the same vein with the remaining transactions, okay? But important thing is that if you're starting to get the idea, is that I want you to go from the transaction straight to the general journal. That's the aim. This is really what I would call your training wheels. You're analysing a transaction in order to get to that final result. All right. Let's go to the next transaction. We paid wages, $1,000. Accounts involved, wages. And the other one, something to do with cash, so obviously it's going to be cash at bank. All right. Type of account, wages is a new type of account I haven't talked about. It's an expense account. The cash at bank account we've already seen is an asset account. Okay, the nature of account, by rules that I taught you the last lesson, an expense is always a debit. Okay, and as you already seen, the cash at bank is a debit account. In this instance, the wages account, we incurred a wages account, a wages expense, I beg your pardon, it went up. Okay, let's apply the rules. A expense increase is a debit. Okay, the amount was $1,000. Cash at bank account, we actually paid some wages, it went down. Okay, applying our rules, asset, decrease, credit. Okay, there we are. So that's the analysis. Let's put it in here. On January the 15th, we had some wages. We identified that as being $1,000, and we paid cash for it. There we are on the credit side. It's a nice simple transaction. Debits equal credits. Beautiful. Okay, we're ready to move on. Let's look at this one. This is a different type one. M. Johnson was charged for some services. Okay, so we did some work for M. Johnson. But the important thing here is that M. Johnson hasn't paid us yet. Therefore, it is what we call a credit transaction. Okay, let's analyse it. So the two accounts here are M. Johnson. All right. Another account is another new account is services performed. services performed. I'll have to make this a bit wider for us. Whoops. Let's do that way. Okay, so we don't get it mixed up. M. Johnson is going to pay us money. Right? There's going to be some cash in our hand later on. By definition, that's an asset account. Services performed is something that we've done as a normal part of our business. It's what we call a revenue. Let's look at the nature of the accounts. As you know already, an asset is a debit in nature, and in the previous lesson I talked to you about revenue accounts being credit in nature. Let's keep moving. Okay, so M. Johnson, we didn't have that debt before that's owing to us. So what that meant is that our asset account went up. It's an increase. And similarly for service performed, that's also an increase. All right. Let's follow those through. An increase in the an asset account is always a debit, and an increase to revenue account is a credit. So when we put in the amounts here, and there's no amount there, let's just say it's for $500. This is what occurs. If we put this information onto the general journal, we're going to get the amount's actually $2,000. Let's just put that in. Didn't put that into my spreadsheet when I prepared this. So let's just summarise this. On January the 21st, whoops, my typing's not good today. M. Johnson, remember that was an increase on the debit side. Well, it's actually 2,000, remember. So let's just adjust that. Here we are. Debit $202,000, and it was for services performed. There we are on the credit side. Alright, so we've got this debit equaling that credit. There's one on each side. It's all sweet, all good. Now the last transaction is where we now are paying ABC Co 2,000 cash. Remember here before we paid $5,000 deposit on the car, and we owe 30,000. So what we're going to do, we're now going to pay some of that 30,000 now. All right, let's see how that works. So the two accounts here is ABC Co, and we're paying with cash, so it's cash at bank. All right, ABC Co, as you worked out before, was liability. Asset for cash at bank, we'll know that by now. And whoops, you know that it's a liability and a debit for the asset. Okay, let's see what happened. Our liability we're paying back. Right, that means that we are decreasing our liability. Right, so let's follow that rule through. Liability, okay, is decreasing, therefore it's going to be debit. And for that amount, what's going to be $2,000. Let's look at our cash at bank. We paid, meant our cash account went down, and that when we apply our rules, a decrease to an asset is a credit. Okay, and you can see how this is working out nicely where we've got debit and credit. So having done our analysis, let's just put it into here. All right. On January the 27th, ABC Co was $2,000 debit. We reduce that debt there. Cash at bank. We paid some money out. Goes on the credit side. And there we have it. That's how you analyse transactions and to put it into the general journal. The important thing that you need to know and be able to do in the exam is when you see a transaction is to be able to identify what accounts, whether it's debit or credit. Right? That is stuff that you need to do in section B of the exam. So in the first instance, if you can't go from there to there straight away, you need to use your training wheels, as I called them before, and do your analysis. But I'm hoping that you can put your training wheels aside and omit this step and go from there straight to there. That's really important. Okay, hopefully that's been useful to you. I'm going to give you plenty more exercises to do with general journals, but hopefully that's been a good start. Thanks for listening.